Portfolio Manager for Canada Pension Plan Investment Board, Ted Lee.
Wow, looks like we have a pretty good crowd, especially after that last session. Yeah, so I guess in the last session you talked about some of the opportunities and things that are here today. We want to spend a little bit of time also talking about tomorrow and the future. Maybe before that, just for this audience, I kind of wanted to share a kind of a personal story. Will hopefully relate to, we'll be able to tie back into our topic on technology. I'm actually originally from Hawaii, and I went back home to Hawaii about 3 weeks ago, and I went, and one of my passions is surfing, like a lot of people in Hawaii. And so I went to my favorite surf spot, and usually when I go there, there's usually like 3 or 4 people that are there, because not too many people know about it. This time I went back and I was getting ready for a great session. It was already Monday, mid-morning, everyone should be at work. I get there, and there's a dozen people sitting out on the waves, and I'm sitting there going, what happened? Clearly, one, don't people have to go to work? And secondly, how did everyone figure out where this place was? So, yeah, and we'll find a way to maybe tie that back into our panel. I hope you will find it interesting. I mean, technology and its impact on the finance industry. For that topic, we have panelists who really represent a large part of the industry, everyone from the hedge fund managers to the allocators and the service providers. So with that, I'll introduce the panelists. On the far right, we have Nobu, who's the CEO of Two Sigma Advisors. And next to him is Ian Martin, who's the Executive Vice President of State Street. And to my left, I have Michael DeAddio, who is the COO of WorldQuant. WorldQuant. And on the far left, Sanjay Tika, who is the Senior Advisor for Kaust. So I wanted to start off with Nobu, and Noble. And we want to really just talk a little bit about this digitalization of finance, and what does it mean to Sigma?
Thanks, Ed. So, well, in the case of Two Sigma, which was founded 15 years ago, the company was in fact founded on a pretty simple, but I think a very profound vision that technology was going to change every industry. It was going to transform every industry and even revolutionize some, and there was no reason why financial services and investment management in particular was going to be an exception. And so if you think about the explosion of data that's been enabled by the progress in computing power, the progress in AI, some of the things which were referred to yesterday, there's been an absolute explosion of data. And what that's also meant is that the approaches that are needed to make sense of this data have to evolve and dramatically change. So if you look back just a few decades ago, the world was a much simpler place. You could imagine that an analyst could look at a particular company. The companies were much more vertically integrated. There were fewer of them. The largest companies represented a huge portion of a country's market cap. The world wasn't so global. So you could imagine that through research and insights and so on, you could derive an information edge and take your time and make an investment. And maybe even you would have a few weeks or a few months that information edge would help you and last you to generate some positive returns. In today's world, where there's been an absolute explosion of data, the markets are interconnected, the trading is fragmented. On one hand, the world has become much more efficient. But the world has also become much more complicated. And if you look at a single company, take Apple, that company has hundreds of different suppliers around the world in its value chain. There are millions of variables that are affecting the performance of a company of that complexity. And to imagine that a single human could try to make sense of all of the data and all of the variables on a global basis that are affecting one security, let alone a portfolio of security, is actually just inconceivable when these markets are so fast and electronic. And if you wanted to execute a single stock, I mean, Apple trades on dozens of different venues around the world, and that requires, the answer to that is, of course, technology.
Great. Noble, thanks. So Michael, so how has your business been affected, and how have you kind of evolved your business with these technology changes?
Sure, thank you, Ted. I want to echo what Noble said, is that the explosion of data has changed things in a variety of ways. The easy ones to know are there's a lot more data. We're all out there looking for it. You can make better decisions, trading decisions. So data is huge, but it's also changed it in other interesting ways that might not be so obvious, which is almost every company out there is a data company in the making. It doesn't matter what you do almost, but we are out there looking for companies that don't even know that their data is sellable to folks such as ourselves. They're just trying to do their business, but in doing it, they're acquiring all this data that can actually be very valuable and interesting, and most of them don't know it yet. So I think that's an interesting change to the world. I want to go to the more mundane for a second, though, and saying it's also changed how you can build a business. WorldQuant, we're in 21 offices in 15 countries, and yes, we have over 500 people, but that's spread pretty thin. I would say 10 years ago, it'd be really hard to build a business like that and operate it well, but we can today. Why? Because we have a consolidated general ledger with the same chart of accounts. I know that's boring to everybody, but it actually runs a business. We're able to use virtual technology and express, we call it the $100,000 office. We can open an office in Budapest for $100,000. Regis, virtual technology, boom, you're up and running. So that barrier to entry, to enter these things and building a company that's truly global is amazing. And that's also a part of the technology explosion we're seeing, which allows us to run our business around the world looking for the best talent at a really reasonable cost, whereas 10, 15 years ago, the cost to do that would have been, I think, orders of magnitude higher.
That's great. I mean, yeah, clearly barriers to entry is another key theme related to technology. Maybe Sanjay, you can talk about how Klaus has thought about technology and how it's affected your business.
Sure. So Klaus is a university endowment, so we touch on this technology, use of technology internally, and then a lot of what we do is invest in external managers, some of whom are highly technology driven. So I think Klaus has a bit of a reputation for being quite advanced by endowment standards. So a lot of investment has gone into technology and developing internal systems. I think one of the misconceptions of that, though, is that sometimes people think that we're a highly quantitatively driven investor. And that's actually not true. We have a lot of technology, but in the end, it's a qualitative process. So it's largely about using the technology for internal productivity of the investment team, which is slightly different from the approach of actually making investment judgments or driven by just by data. And I think in keeping with, sort of somewhat similar to perhaps most endowments, part of the mandate is to have a highly diversified portfolio, both in terms of strategies and geographies. And what that means is you end up with a lot of complexity. We're investing in a lot of different strategies, very, very distinct in the kind of information, and also dispersed geographically, in a relatively small team that needs to travel a lot. So we spend a lot of time on the road almost continuously. So what technology enables us, I think, to do is, as a very small team, to operate quite a large pool of assets in very complex asset classes. So I think right now, I'm in Singapore, I have a colleague who's in Beijing, one of our colleagues is in London, and this is the mundane part of technology, but we can all communicate and look at the same things, and a lot of effort's gone into making that work smoothly, so that we can have internal discussions as well. So it's one type of technology that we focus on. And then, of course, on the other hand, we're investing in technology, so we're sort of evaluating managers who, to varying degrees, are using technology.
Great, and we'll come back to some of these ideas around portfolio construction and also the manager selection and its implications for the asset management industry. Maybe Ian, you can talk a little bit about how technology has affected the custody and administrative space, and maybe give us some kind of previews or thoughts around, what the future might hold for your business and, the advent of technological changes.
Thanks, Ted. I feel a bit of a fraud sitting up here talking about technology when I sat through some of the sessions yesterday on AI and fintech, but I'm going to try and focus on the implications it has for our business. State Street is a large custodian. We provide safekeeping, we settle trades for people, we provide all the aspects of administration. So as things stand, we are providing the plumbing to the industry and looking after some $28 trillion in assets. So that's sort of 12% of the world's tradable securities are floating through our pipes. And if you think about that, if you're not a technology company, then you're going to have some problems managing that process. When I first joined the bank, which was many years ago, our then CEO, Marsh Carter, whether he coined this phrase or not, I'm not entirely sure, but he referred to us as a technology company with a banking license. I think if you had invested $1 in State Street in the 90s as opposed to $1 in Apple, I think you know the answer to that question as to how we did in being a technology company. But notwithstanding, it's been at the core of what we do, and will remain so. So we've been on a journey in terms of trying to solve some of the major problems that exist in providing the types of support that we have. And most of it's around latency. Most of it's around the inability of financial markets today to deliver back data so people can use it in a real-time way. So I guess the nirvana in our business is being able to provide clients with a real-time NAV. So our journey has definitely been around I guess recoding all of the big substantial infrastructure that we have. The development of a private cloud has been very important to us. You can imagine in servicing the types of clients that we have, you know, which are underpinned by millions of private investors, sovereign wealth funds, large pension funds. Privacy is a huge concern. Privacy, data security, threat of cyber. So the private cloud has been a significant advance for us. Today, what we're doing is sort of embarking on the second part of that journey, and that's really around the digitization of everything that we do. If you think about what's important, a single piece of data comes into our organization. Typically, the challenge is how it moves through all of the handoff points, all of the affirmations, reconciliations, all the things that we need to do to ensure that an NAV is printed or a trade is settled. So digitizing that process, allowing the one source of truth, allowing that piece of data to flow horizontally through the organization, kind of untouched by human hand. They're the things we're working on. And then I think, you know, our clients or the industry itself should expect to be able to think about real-time NAVs and the delivery of data in that sort of time frame.
Yeah, I think you also mentioned about some of the settlement being able to be even done the same day. Is that right?
I think absolutely. I mean, I think we could probably come back to some of the technologies that are really changing things, but inevitably blockchain, distributed ledger, all of the things that it purports to do offers very clear line of sight to same-day settlement. I know the Australian Stock Exchange is currently under a fairly substantial review of their CHESS, their settlement infrastructure, clearing and settlement infrastructure, and they will deploy some form of blockchain technology. And whilst you know, some parts of the world are moving from 3 to 2-day settlement, T0 is out there, and if you think of the implications that has for the market in general, the ability to trade, to implement, to deploy capital, most importantly, in a sensible way, it's really that's revolutionary in itself.
Yeah, I mean, it's quite interesting. I mean, we always think that, you know, the administrative and the custody business pretty, you know, day to day, pretty standard and plain vanilla and not so exciting. But, you know, there are things seem to be going on under the surface that can be, you know, have a direct implications and changes to our different strategies. Maybe we'll move on to talk a little bit more about, I think, something Sanjay talked about, which is asset allocation and the dynamic that technology can play, both in terms of, we talked about this explosive data, but also whether it's, you know, decision making or assisting in the decision making. So maybe, you know, want to continue on maybe that topic, Sanjay?
Sure, I can. This one area, of course, sort of asset allocation is part of what we do in addition to sort of manager selection, sort of allocating to external managers. And the process, I think one of the things for an endowment is that we actually sort of bombarded with data. There's actually too much data, and the process is quite, has a lot of subjective judgment involved. But I think one of the things we have to remind ourselves is we're not a global macro fund. So we're not trading or making big decisions. We're making shifts when there are major changes in themes, perhaps tactically. And I think one of the temptations there is sometimes with a lot of data is you sort of overuse the data. So we have to be quite careful about that. And I think so sometimes sort of we hire a new analyst, and I can think of this, that who are very eager to use all the skills they've acquired in the data to produce certain types of reports. So a very typical situation, I think, is have a new analyst, he comes up with a report to 3 decimal places, right? Whereas the subject matter itself is sort of whatever the item is plus minus 2 is probably the sort of error in that there's so much noise in this business. So one of the first things I think to teach analysts is actually that degree of accuracy is a bit of an illusion, right? And the other thing I think sometimes, again, this is sort of saying how we're careful about the use of technology, is that very often sort of, especially fresh analysts, very smart, who believe that if you throw more math at a problem, you're actually going to solve it. You throw more math at asset allocation, and you're going to come up with a better asset allocation scheme. And there's a danger there as well. But I think for us, it's more developing themes for broader global trends. And they're not always captured in price data, but they could be captured in sort of broader economic variables. So we get a lot of input, and then it's used for discussion, rather than actual models that are generating portfolio weights.
Sure.
So it's more for discussion purposes internally, and a lot of sort of some in-depth research on particular themes that might be influencing the space. But generally, we try to make it as forward-looking as possible. So that's, again, sort of some discipline involved there.
Yeah, I should see CPPIB. We're probably more similar to your account, but maybe, Noble, you want to talk a little bit about some of the things that you're seeing with some of your clients or some of the requests you've been receiving?
Sure, yeah. So obviously, Two Sigma is an investment manager. We get hired. We manage $37 billion on behalf of some of the world's leading allocators, institutional investors, some sovereign wealth funds, some of whom are in this room, pension plans, endowments, foundation, insurance companies. But at the end of the day, $37 billion seems like a lot, but relative to the size of the assets that our investors are responsible for, it's minuscule. And we're proud to be hired as a manager for the specific product, mandate, hedge fund, or long-only mandate that we get hired for. But at the end of the day, are we making a difference in the grander scheme and the first-order challenges that the allocator has? And so in that spirit, over the last few years, a number of our clients have approached us to see whether the process that we go through to use our optimization technology, our execution technology, can help them achieve their objectives, their first-order challenges. And we call that solving for the pie rather than solving for the slice. And so if you step back a little bit, at the end of the day, what our clients have told us is their challenges are in fact no different. In investment management, it doesn't matter what kind of investment management, you're doing 3 things, right? You are forecasting returns and risks of the assets or the managers that you're selecting or the portfolio that you're going to be investing in. You're building a portfolio and you're managing risk, and you're ultimately executing and you're implementing that as efficiently as you can. As investment manager, we're selecting securities and we're building portfolios of those and we're executing those in the markets. As an allocator, they're selecting perhaps managers, or in some cases they're investing directly into assets. But the technology that can assist with the optimization problem or the execution problem is actually very transferable. So in recent years, we've been working with a number of our clients to help them solve those first-order problems. And so they range from an insurance company that shared with us their other managers' returns and asked us to analyze, put those through sort of an X-ray, and to kind of think about whether those managers were generally delivering alpha or whether they were charging active management fees, but in reality were delivering them mostly more generic risk premia and even market betas. Another pension plan asked us to look at their portfolio to see whether, looked at it through a more quantitative lens, they were achieving the level of diversification that they were seeking. And again, some of the risk management tools and some of the portfolio construction tools that we've developed originally for security selection, we were able to help leverage those to help them advise. And in the end, it turned out that they weren't as diversified that they thought they would, and we could help them think about some more optimal rebalancing.
Great, Noble. Michael, I don't know if you want to.
Sure, I'll add to what Sanjay said, that there is an explosion of data. We have probably 600 data sets we use on a regular basis, and our goal that we're very close to reaching from a security selection part of the process for portfolio construction, we're up to trying to trial about 1,000 new data sets a year, and then buy the ones that help us add to our portfolio and our ability to generate returns. Now, it's quite interesting, however, that with that explosion of data, you have to figure out what's causal and what's not, even when the numbers look good, even when we apply all the systems and optimization techniques and alpha generating techniques that we've got. I recall when I was finishing university that my thesis advisor said, if you touch your data too much, you go blind. And now I think I extend that to, if you trust your data too much, you might go blind. Because there's a far cry from seeing something initially, getting to that third decimal place and thinking it means something, to it actually meaning something. It actually either being predictive or adding value. And so that's what I think everyone's faced with as we see this explosion of data and the technology available now in the cloud. You don't have to put it on your balance sheet to actually analyze it. But what does it actually do? How, as Noble said, how do you add value from all this data versus just there being a lot of noise? And that's where I think we're all the most challenged is, this is great for us, but separating the signal out from the noise has gotten harder.
Yeah, that's a great point. Ian, talking about, separating the noise and, the massive amounts of data. You guys see as much data as almost anyone. How do you think of that, and how do you help facilitate your clients in addressing some of these concerns?
Well, certainly on a couple of levels. The nature of our business has changed quite dramatically, really, whilst we still provide safekeeping and all of the associated administrative support to clients. The one thing that's clear to us in every conversation we had with our clients, and that's that they have data challenges. Now, a lot of our clients, let me tell you, aren't as sophisticated as these guys, and they're battling with this as how do they manage it? It shows up in pretty much every line of research as being a significant problem. So for us, we recognize that we are in many instances perhaps the primary data provider to our clients. And so what we've done recently is to try and be more sophisticated and thoughtful about that. So that's where we are the primary data source. They may have multiple custodians, they may have asset managers, they may have price feeds. We're starting to aggregate all of that data, normalize it, do all of the good things that needs to present that data into a manageable form. Why is that interesting? As a core activity, it's not very exciting. It's about data aggregation and warehousing. But it represents everything that they're going to need to use to do their core activity, whether that's regulatory reporting, whether that's risk reporting, any types of analysis at an enterprise level that satisfies their obligations and requirements, or whether it's perhaps a higher order type activity where they're using that data for decision support and types of asset allocation decisions and so on. So.
Yeah, and you also mentioned earlier about also the, because you do represent so much of the industry, that you actually have a sense of what's going on in the markets and the flows.
Something we started doing many, many years ago was, it was quite clear with that 12% of the world's tradable securities floating through our pipes, we do have a kind of unique insight into what's going on there. Now, you could argue that on every side of a trade, there's a buyer and a seller, so why is one side more interesting? Simply put, when you look at all of the flows, so cross-border flows or switches out of stocks into bonds, whatever the transition might be, there's information content in those trades. So it ended up being the biggest data set at State Street. We brought together all of that information and we started to compile a body of research around really holdings and flows. And of course, the interesting thing is, well, why is that important? Where does it relate to returns? Where it relates to returns, quite frankly, is that our clients represent the biggest institutional investors in the world, And when institutional investors start to do things, they're not nimble. They're super tankers. If they start to reallocate, then the reality is that thing moves slowly. So what it did present was an opportunity to say, hey, these things are happening and they will continue to happen. They'll continue to happen for 30 days, 60 days. And so it sort of formed the basis of a body of research that we've refined over the years, and we deliver, and hopefully it's helpful as a sort of a decision support mechanism for our clients.
Actually, if I may comment on that, because I think it's one aspect that impinges on endowment, and it's not the most glamorous aspect, perhaps, but I think it applies generally to asset management. There's usually in any delegation, there's some governance required, and that can be a bottleneck in terms of timing. So the higher the quality of your reporting, the accuracy and quality of your reporting, it enables delegation, which enables sort of quicker investment decision making. So that might not seem like the most glamorous thing, but I think it's one thing that actually enables the investment team to function, because whoever the governance body is actually getting timely and quick information, so they can authorize things. Right? So it actually makes a big difference in our ability to function.
Great. Okay. Well, I did. So we talked a lot about what we're facing and some of the issues we're dealing with today. As I had in the opening comments, I did also want to move a little bit to thinking about going forward. And there's a lot of comments, I think, yesterday about how technology is disrupting the marketplace, and clearly with from these different perspectives. And I guess the question is really, how, given where technology is headed, how do you think about your staffing needs? What types of people do you need? How, I guess particularly in the cases like State Street, how will that affect the number of people you might need? So I open that up broadly to the panel.
We are essentially a technology company that makes security investment decisions in the end. That's what we are, and a research company on top of that. So with all these changes, what you see is I see a couple of things. One, on the mundane side again, because since I'm a COO, the mundane side, unfortunately, is what I do have to worry about most days. It allows us to operate more efficiently with less people doing accounting, reconciliations, all these kind of things in a global environment. So it does impact how many people we need. And we've seen the number of investment staff and research staff, our growth there has been far exceeding the number of people we've been needed to run the firm, which is good for us from an efficiency perspective. But if you think about the global aspect of how the world's changing, it causes challenges. It causes challenges in lots of ways. The second thing, though, is that with our ability to reach out around the world, what we've realized is we need to be in even more places. If our business is run on 250 researchers around the world, most of them with PhDs or high degrees in STEM courses, then we need to go and find more of them, because we can. And if we don't get there, others will get there first. So it's sort of like collapsing the bottom side, but forcing a bigger competition for the very brightest and best on the sort of front end side and the investment side, quite frankly, because we can afford more of them and don't need more of these. So it turns that pyramid around and essentially creates a shifting of where we can spend our resources.
Yeah. So Michael, actually, you earlier mentioned also you have 21 offices around the world. Why do you need so many offices then?
Excellent point. So we don't need them in terms of having to be there physically. We need them because talent, we feel, is statistically very well distributed around the world, at least the talents especially we're looking for, but opportunities not. You can't find, we have 60 people in Vietnam, and most of them we can't find or bring, or they want to go to a financial center, New York, London, Tokyo, Singapore. So we really look to bring opportunity there and find the very, very best on the ground, and we see it as a big competitive advantage, because you really can get the very best where you're not filtered or biased by visa concerns, by people who don't want to leave home, by people who don't want to be in some of the bigger cities that you are in naturally. So that really is a search for talent and bringing opportunity there versus looking for it where you happen to be.
Yeah, and I guess if you can set up an office for 100,000 setup fee, it gives you a lot more capability.
It gives you lots of flexibility. It also gives you the flexibility to fail. It's not like it has to work. Sometimes you'll show up, you can't find the talent you're looking for, and that's okay. Yeah. It's okay to fail.
Good point. I know, Noble, your business probably has similar dynamics. I don't know if you had anything to add.
No, I think that, look, we are a technology and a scientific company, and this was the case when the company started with 15 people. 2/3 of the employees were R&D, were scientists and engineers, and today the company is more than 1,000 people, and still 2/3 of the company is scientists and engineers focused on R&D. And in fact, more than half of them don't even come from the finance industry. So the mindset, the DNA, the culture of the company is very different. It has to genuinely, you can't just say you're a technology company, it genuinely has to feel and behave like a technology company. At the end of the day, what is Google? Is Google an advertising company or is it a technology company? Is Amazon a technology company or a retail company? I think that this has to be from within the heart of it, and it's a different mindset. I mean, yes, technology enables automation, and that's important, but many of these problems and many of these transformative things that we're seeing in finance require just an entirely different approach and a very different scientific mindset to really solve from within. So that's I think that is really where innovation is going to continue to come from.
Can I just jump in and add to what Noble said is, you would see that usually if you're a technology or about your State Street, your technology group might compete with the Googles and what have you of the world on the sort of engine, the block and tackling part of it. Our businesses, we compete, the people we compete with are the front end. They're the researchers making the alpha trading signals. They're the ones on the front end helping us actually do what we do, not in the sort of maw of it. So when you look at the financial companies competing for the exact same talent right out of school, 80% of our people come with no financial experience whatsoever. We're competing with the Googles of the world for jobs right in the front lines of our financial company. So it's an interesting competition because it's the same people.
One thing that's been very effective for us is that because we invest in managers who have a lot of infrastructure and skills, to sometimes get help from them in sort of jump-starting some of our processes. Because as an endowment, staffing is certainly not at the same level or resources, but we do have strong relationships with managers, and it's a win-win situation because they already have the teams and systems in place, and it facilitates our work. So I think that enabled us to set things up much more quickly than would otherwise have. So it's not actually, they're not giving us the system, but it's more sort of a dialogue with our team that jump-starts the process. And that's been very, very effective for us in implementing things.
Yeah, same for us at CPIB. I mean, we really, particularly on new initiatives, going to the experts, particularly in the market. I also thought the point that both of you made around no longer going just to Wall Street to find people, but really going to directly to where the talent lies and where it's not really even filtered, I think is implied in that is also an element of being able to really shape kind of those people in a certain mindset and way of operating, which is quite different. Before we move on to the other next topic, I think particularly State Street now, with thousands of employees, in a business that's been run for quite a long time, how has technology changed your business in terms of both the number of people and the type of people that you will be hiring in the future?
Well, certainly we went through a major IT and ops transformation that really redistributed some of the tasks that we do. In particular, a very successful partnership with Zhejiang University in Hangzhou, where we started off doing a bit of technology together. We now have 2,000 people in Hangzhou doing operations and technology for us. So that's been part of a redistribution. But in all that time, in essence, State Street's workforce has stayed broadly the same at around 30,000 people. I think the digitization that I spoke about obviously is about efficiency. Obviously, it's about taking out a whole set of activities that we do today. We do hundreds of thousands of reconciliations of breaks in trades every day. We still receive 60,000 faxes. Now, it's interesting because you sort of think, well, what are you guys doing, right? I mean, where's your technology? Why haven't you changed things? Technology fixes are very good when they're controlled and internal, but you can't necessarily force things on your clients, right? And clients still like sending us faxes, and so we've got to try and deal with those sorts of problems. But this digitization issue will take out some of the lower level jobs inevitably. That's about the efficiency. What we're interested in is what then takes their place. So We look at the types of people who are looking for jobs, millennials coming out of, we head offices in Boston. We have two of the, the finest universities on our doorstep. The types of people who are coming to us today are looking for higher order activity. We'll never lose room for people with good client skills. They'll always inevitably, in spite of the robots we saw yesterday, I still think people are going to want to talk to other people, hopefully. So those sorts of things, but much more around analytical jobs, problem-solving jobs, rather than functional, I've got to find a break in this transaction and replace a broker code type job. So I think that's the evolution for us.
Yeah, so I mean, it sounds like the demand, particularly for the finance industry, will be much more around some of these technical skills, but at the same time, some of the more people communication skills, which clearly, sometimes don't overlap, as we were talking about earlier. Maybe as a father of 3 young boys, given what you've said, what kind of advice would you give for a father to think about what kind of education and experiences their children should have, given this digitalization, the massive quantities of data, and this future where you might need to be more technical or have these interpersonal skills. What other skills might you need to be successful in the next economy?
So Ted, I have 2 boys, and I think about this quite a bit as well. My wife and I talk about this all the time. So clearly, more exposure to technology, and I think many schools are reforming their curriculum. I think I'm actually speaking with my alma mater at the Wharton School of the University of Pennsylvania. I've spoken with a number of professors about how to reform the training that we give graduates today, people who will graduate in 4 years versus what they were taught and what they were trained in 20 years ago. So this is, I think, something that many education institutions are thinking about. I think we shouldn't overly obsess about the technical aspects of it. The theme that really resonates with me is adaptability. Because one thing is for sure, that whatever we're learning today is going to become obsolete more quickly than it used to be. And so I think it's almost learning to learn and continue to retrain yourself is, I think, the skill that's going to be one of the most important things going forward. Because you can pick up a computer language today, and maybe in a few years that won't be the most effective and the most efficient technical skill that you will need. But if you learn to learn and to reinvent yourself, I think that the careers are going to be such that people will have to retrain themselves on an ongoing basis.
And I wanted to add to that as well, having a boy and a girl, and watching the way they learn it's amazing to me. I see, so first I'd say, don't worry so much about to have that iPad for too long. Everyone's like, oh, take it away, cut the iPad time. I don't know, because what I see them doing on it is learning to learn. I see them not being afraid to look at something new and go after it and figure it out. Not being afraid that because they don't know it, they can't know it. Because information is now at their fingertips. And I have to say, long ago, I could never figure out why YouTube was going to be interesting. And my children now, the first thing they do, we bought a pool table. As they got a little bit older, my son decides, I want to learn to play pool. What does he do? He looks at how to play pool videos on YouTube, and now he beats me regularly.
Sounds a little bit like The Matrix.
And he's 9, so it's a little hard for me. And I try really hard, and he still beats me. Yeah. So I asked him where he learned, and that's where he learned. So it's not what they learn, it's the fact that they're comfortable, confident. They look at a new thing, and they say, I can just go learn this. Because the ability is there, they don't have what I think from an earlier generation, how do I go learn that, and should I be afraid of it? They just dive right in. And I think that is a massive change that will really, as we sort of get into our older age and this generation comes forward, that will really change how the world works and how education works and how learning works.
I have a I have a nephew who's about 8 years old, and usually sort of every year around his birthday, there's a bit of a negotiation about his birthday present, and he always manages to get out of me something that his parents don't quite want him. But I was talking to his father about exactly this question, and I told him that what he's got is charm, And charm is something that is never going to get obsolete. So it really doesn't matter what he studies. Because, and actually to make a more serious point, it has to do with interpersonal skills, right? That's to make it a more serious point. I think that aspect of things is relevant, whatever the particular technology is applied, right?
Yeah.
Look, I have 3 girls between the ages of 18 and 24, and I have reached the point where I don't offer advice because it's not welcome and it's not respected. But if I were to offer them advice, look, I think it's interesting living in a family with 4 women and myself. So we do talk about some of those challenges. I think for them, it's definitely, there are no barriers. You know, some of the things was great having dinner last night and listening to the CEO of PepsiCo and some of the things that she's achieved, and you know, and she's not out there in her own, but the opportunities for women. I think we've had some interesting discussions where you know, we've talked about how a woman might have had a good opportunity to take a job because it was the right moment in time for her. My daughters were affronted that someone might get a job in some sort of some balancing type of transaction, and I think it's because their attitude and where they're at in life is that they're just open to everything. They're not seeing any barriers. So I think that's you know, having 3 girls and thinking about what they're, you know, hopefully going to be doing, looking after me in future life. I'm pleased to see they're very open-minded and getting out there.
So they should have some healthcare expertise as well.
Well, I hope so. Yeah, that's right.
So I think the other thing that was mentioned, in addition to the first 2 skills, I think the panelists talked about was also problem solving, and I think that was also, I think, you know, as there's so much information, you know, coming our way and it keeps getting more and more, how you be able to filter, but also think about implementing and using that information to be effective. I think that was another key point. I would just note, you know, I do want to be able to have some time for a Q&A. So I'm going to do one more question and then open it more broadly. So if you can think about some of your questions in advance. So the other question we were going to talk about that's a little bit, maybe stir things up a little bit more, was, you know, we have two quant-oriented strategies here. And one of the things that in our pre-session Sanjay mentioned to me was this idea that, you know, a lot of these strategies have a zero-sum opportunity, that, you know, when one group is making money, someone must be losing. And I really actually found that to be quite an interesting one topic, dynamic, and potentially something a bit more controversial. So I kind of wanted to raise that as my next question. What do you think about this idea? Maybe I'll start with Sanjay, since you started the question.
Sure. I mean, we invest in a lot of external managers, and some of them are involved in highly competitive spaces. So I think there are 2 things that we're cautious about. So one is sort of crowded competitive space. Another is whether the actual returns are a zero-sum game. Because the question we have to ask ourselves is can this manager consistently win at what's a zero-sum game? And, or will these returns be eroded away? And then secondly, we've got to ask ourselves, why are we good at picking managers like this? Because clearly everyone can't win. So, there's, whether it's luck or their consistency. And I think the larger the allocator you are, the more you have to ask yourself this question, because everyone can't be above average, if I can put it another way. So there's certain sort of hubris involved in believing that you're going to win consistently at a zero-sum game.
I think, Sanjay, you're absolutely right. I mean, if you're an allocator and you're thinking about zero-sum games, you're probably playing the wrong game. I mean, there's just simply, if we talk about alpha by definition is excess return. It's a positive return, it's idiosyncratic, it's uncorrelated with other betas, and so on and so forth. By definition, there is not an infinite amount of it, and it is a zero-sum game. But returns are not the same as alpha. Mm-hmm. And I think it's important, and I think investors are becoming very savvy about being able to tell the difference, that there are many components of returns. There's a beta component of return, which should be virtually free, and there is risk premia component to return, which is much more scalable, and often gets confused with alpha, and then there is true alpha. But if you are a large allocator, to use Ian terms, if you're one of those super tankers that you reference, there's simply not enough alpha in the world, even if you have the skill of picking the right managers and getting access to their scarce capacity.
well, actually, this is squarely actually on my area, which is one of the bigger funds and bigger allocators into the hedge fund space. You know, while it might not drive your returns as a rebuttal, being able to generate, $1 billion in some cases, in some years of additional alpha to the portfolio, won't maybe drive the overall portfolio, but does show incremental value as like rebuttal, I guess.
And I want to rebut it a little bit as well. I mean, in the bigger sense, the world is driven by global GDP, right? And you can't do anything like that. So if you're the world investor, then maybe there's no alpha. But with the exponential rise in data, with the exponential rise in technology, I think there's more than enough alpha, and I'll quote our CEO, Igor, if there's exponential data, there should, in theory, be exponential alpha within the world, at least we work in. And our goal is to go find it. And we started with 1 alpha in 2001 or what have you, or 1996, I'm sorry, and now we have 2 million as we count them in terms of their little units. So it's out there, and it's not like the well is drying up. As a massive supertanker, you have to pick your spots to find it, no doubt, because you can outperform the market if you're that big. But in terms of actual finding alpha, we believe there's a lot more out there, and we're by no means at the end of it. We're at the start of it as this data revolution and exponential growth continues.
I think one of the sources of...
Sorry. No.
So I think there's a definition issue, right? Everyone uses the word alpha
right.
in a slightly different way. When you say there are 2 million alphas, I don't know exactly what you mean by
that. It is. It's a unitization of it, right? It's just the way we happen to count it. But what we've seen is our ability to find the units is just growing, however you count it. And then I think back to your point, there's also a definitional issue on what are your goals? What's the definition of good, right? You could have. I had one allocator say to me yesterday, if I make 8% every year on a regular basis, people just leave me alone. Right? And that's the absolute return view of it. It's like, just make 8% and I'll be happy and everyone will leave me alone, versus risk premia, outperforming an index, things with far more capacity. So it's also definitionally, what's your objective and what are you trying to get out of it as well.
I was going to say that one of the sources of inefficiency that managers are trying to exploit is institutional rigidities, or sort of problems because institutions have governance or restrictions. So there's an irony there that sort of, as institutions, we're investing in managers who are exploiting the inefficiency that we've created, right? So,
okay, that's a
good point.
Those, by the way, those are often called risk premium. Those are structural inefficiencies that the market has in it that people are leveraging and people should be harvesting. But there's an intelligent way to do that, and that is not the same as alpha, though.
Yeah.
Fair enough. Okay, so that I would open up to the audience if they had any questions. Is there a microphone? Yeah, I think there's someone in the middle here.
Thanks very much for the presentation. My name's Jethro Goodchild. I'm a portfolio manager at Aviva Investors. Bond market liquidity, and it seems to be one of the biggest issues facing the asset management side, and there's lots of technology solutions out there trying to, I guess, fight against the regulatory and I get the regulatory issues coming against the liquidity on that side. Can anyone comment on the technology that you're seeing or using to try to improve the trading side of things? Because it's quite a challenge, certainly on the bond market side of things, as liquidity is certainly one of the biggest issues facing large bond managers like ourselves.
So my comment will be more general than just the bond market. I mean, I think that there's been many changes in the market structure. In some cases, that has reduced the liquidity in fixed income products. In some cases, with the evolution of central clearing and things of that sort, it'll ultimately, hopefully, bring back some of that liquidity. The equity market, or the FX markets, which is perhaps one of the most liquid instruments that you can think of, I think there's also been substantial change in the form of fragmentation and electronification of the markets and the globalization of those markets. And to many people, that complexity comes across as being a lack of liquidity or being a rigged market game, as one novelist put it a few years ago. And I don't think that's actually true. I think that's a misperception. The evidence shows, if you do research, that the markets have actually never been more efficient. Mm-hmm. It is now, the spreads are narrower. It's actually cheaper to implement a trade than it ever was over the last several decades. But you have to be instrumented to be able to do that. The markets are very different. They are definitely much more complex. They're not unfair. They're in fact fairer than they've ever been. They're more efficient than they've ever been. But they are definitely more complex and more fragmented. And in order to operate in those markets, you have to invest in the right kind of technology and the right kind of measurement and instrumentation to be able to do that. And not everyone is going to be able to evolve with those markets and be able to invest in the technology to do that. So in fact, one of the things that we're helping one very large institution is we're going to allow them to use our technology to help improve their slippage. Slippage is in fact one of the biggest opportunities for large institutions to achieve their return objectives. There are studies that show that the average mutual fund may be leaving north of 100 basis points on the table simply through sloppy trading, through slippage that is unnoticeable. And I think that that's something that people should be focusing on recouping, but most people don't talk about that.
Just to add on to that, we've run and operated very substantial foreign exchange electronic trading platforms, CurrentX, FX Connect, for many years, and have in fact aspired to do something similar in the fixed income space. The challenge is the fragmentation. Suddenly you've got 4,000 lines as opposed to 6 trading currencies. That's been a problem. We still think that there is a role to play, deploying smart technology, whether it's blotter scraping type, the sorts of things that are much more developed in equity markets, has some scope, peer-to-peer intermediation for someone who's not in the market. But the fact is that the central points of liquidity have diminished because of the capital impost on banks playing in that space. So I think it's probably going to get worse before it gets better.
Okay, second question here. The mic's coming, just give a second.
I'm Rajesh Jain from Netcode Solutions in India. The question is for Michael. Michael, you mentioned that you'll use in WorldQuant 600 data sets for making decisions. Can you give some examples of these data sets?
Well, I mean, you obviously, how about I give categories, right? Because some defy categorization, but you have your standard ones, and everybody knows them. Price volume data sets, fundamental data sets. The data sets that start to sort of grow up from there, news data sets are incredibly valuable, a little bit harder, but you have to put a lot more work into them. Social media data sets, very interesting, a tremendous amount of research being done there. We've just sponsored the new launch of the Institute of Data Sciences at MIT, which will be launched next week. We're one of the 3 sponsors, and one of their big focuses on how is social media changing the markets themselves as a part of the markets. And then you get into esoteric things, and you sort of move up the extracting value from these other data sets, be it number of cars in parking lots, be it all these web scraping technologies where you let them see where you click, and it tells you things. Extracting value from that continues to get harder, but there's just an explosion of them, right? So it's sort of like you look at the buckets of it, and then you just try to figure out, well, how do you use it? And then, as I said earlier, some companies are data companies and they don't know it. Recruiting companies are. They don't even know it. And you actually have to go and teach them.
That's a great point. Maybe for the last question over here.
Good morning. It's an interesting session to attend. Thank you so much for that. I'm Ritesh Maheshwari from S&P Global Ratings. And my question is to the fund managers and allocators on the panel. You've talked about the fact that technology has helped you run with smaller offices, geographically distributed business models. You also mentioned that you can do with smaller number of high caliber analysts now, and of course that there is an explosion on data. I would like to understand from you, is there a place for intermediate, so data is at the base level, whereas you end up getting an analytical output which enables your decisions. Is there a place for intermediate, half-baked, half-cooked kind of insights which can help you in your business model? Kind of make or buy decision on analytics.
Right. I have to say, personally, we're very cautious about it, and in part because you start with raw data, and then typically some assumptions built into it. And the further along you get the path, there are more and more things or assumptions built into that, what you're seeing. And if that's all you see is the end product of that, you can easily be misled. So we're quite cautious about using intermediate sort of analysis, or even we try as far as possible to sort of look at raw information so that it doesn't have some kind of assumption about the world or about the economy built into it already, right?
I'll add to that before we run out of time. So I echo Michael's point. A lot of the world's data is unstructured and is not just readily available and distributed, cleaned up for you, delivered to you in databases. And so in many cases, you have to go seek this unstructured data. 7 or 8 years ago, we started on a new source of data, which we call alpha capture. And that is about trying to tap into the sentiment and the insights that the sell side offers to the buy side, routinely over the phone or over IMs and voicemails and so on and so forth. And as a algorithmic company, we weren't tapping into that source of data. So we built a proprietary system that is now deployed over 2,500 different salespeople across 100 brokerage firms around the world. That's probably one of the largest coverage networks that we get from the sell side. And so the sell side is providing insights. Those salespeople are providing insight by way of trade ideas that we are integrating. And to us, that's a diversifying and a very complementary and a very proprietary set of data that perhaps meets the definition of your intermediate kind of data set.
Great. Well, thank you all. I think over the last hour we really covered, or 45 minutes, we covered the explosion of data, the use and opportunities and risks related to it, some of the more human elements to technology and how it might affect both our existing businesses and the next generation, as well as the fact that technology affects everyone. So with that, I'd like to thank the panelists and the audience for attending. Thank you.